Hello guys, it's Alex FS. Welcome back to another video. Okay, on today's video we have a special topic: how to trade gold. How to trade gold. Let's go. So human beings have long valued and treasured gold for its inherent roots and molybdenum. In fact, gold has been used in human commerce since the society of the ancient Middle East over two, over 2000, over 2005 years ago, making it the oldest form of money still recognized today. Gold long track record as a store of value despite war, natural disaster, and the rise of the great empires mean that it's generally seen as the ultimate safe haven asset. Okay. Let's, so during the old times, that is these of 80s and 90s, gold skyrocketed from this at this level to this level. So from the beginning, God have been a special method. That has been a special way of exchanging money. So while gold has generally held its value for centuries, traders' interest has waxed and waned in recent years. From the early 1980s until early 2000s, there was little interest in trading safe haven gold amidst the strong, stable economic growth and high-flying stock market. As a result, gold generally consolidates between three 300 Oz and 500 Oz for 20 years from 1982 to 2022. Interest in gold grew slowly through the 20s before exploding with onset of the Great Financial Crisis in 2008. Gold price rose in sympathy, hitting an all-time high above 1,900 in late 2011. In this guide, we will discuss the major forces that drive gold price, along with some ideas of trading strategies and some of the most common methods of trading gold. Factors that influence gold price. Gold is one of the most difficult financial assets to value. Gold is similar to a currency like US dollar or the euro because it's durable, portable, uniform across the world and widely accepted. However, unlike these more commonly traded currencies, gold is not supported by an underlying economy of workers, companies, and infrastructures. In other words, gold is more similar to a commodity like oil or corn because it comes from the ground and has standardized physical characteristics. Unlike other commodities, though the price of gold is often fluctuates independently of its industrial supply and demand. Because of its dynamic, the emotion and behavior of traders tend to drive major trend in the yellow metal with gold more than any other assets. Diehard gold bugs who believe that gold should be worth $10,000 and us because central banks around the world are debasing their currency and bearish traders who assert that gold is a barbaric relic of the past that should be worth closer to $100 as the chart above shows the gold bugs view developed into a bit of a manner back in the mid and the late 20s, though the more recent drop suggests gold may be losing some of its precious luster. Gold and USA interest rate. So, historically, one of the most reliable determinants of gold price has been the level of real interest rate or the interest less inflation. If you think about it, this relation is straightforward. When real interest rates are low, investment alternatives like cash and bonds tend to provide a low or negative return, pushing investors to seek alternative ways to protect the value of their wealth. On the other hand, when real interest rates are high, strong returns are possible in cash and bonds, and the appeal of holding a yellow metal with few industrial use diminishes. One easy way to use a prompts for real interest rate in the United States, the world's largest economy, is to at the yield on treasury inflation protected securities. What is the correlation between gold and US dollar? Correlation. One of the biggest points of contention of gold for gold traders is on the true correlation between gold and the US dollar because gold is priced in US dollars. It would be logical to assume that the two assets are inversely correlated, meaning that the value of gold and the dollar move opposite to one another in layman's terms. It takes fewer dollars to buy an ounce gold when the value of dollar rises, and it takes more greenbacks to buy an ounce of gold when the value of dollar is lower. Unfortunately, the overlay simplicity view of the correlation does not hold in all cases. The charts below show the rolling 100-day correlation coefficient between gold and US dollar. The correlation coefficient measures how closely together gold and US dollar have moved over the past 100 days. A reading of 1.0 should show that they have moved in perfect locked steps with one another, while a reading of 1.0 minus 1.0 shows that their movements have been diametrically opposed. Let's go there. As you can see, the correlation is a negative the majority of the time, showing that the US dollar does not tend to move opposite to gold. Okay. However, it has also shown a tendency to spike rapidly in periods of financial stress, such as in the depths of the great financial crisis in early 2009. At the end of the first edition of quantitative easing in May 2010, this because traders will buy more gold and US dollar as safe haven assets in period of uncertainty. Traders who brutally trade on the assumption that gold and the dollar are inversely correlated would have encountered a couple period of tough markets conditions and likely losing trades over the past few years. Gold correlation with US dollar is one of the crucial piece of puzzle, but as we noted above, there are many other factors that drive gold's value. These charts illustrate how the movement from gold from 2006 to 2012. See, this minus is one, it's moved invertly. Like, so there's a point gold move more than 0.5, also drops and move again. So this is a new chart, how the gold move, gold trading strategy. As with any trading instrument, there is no single best way to trade gold. Many traders from other markets have found that the technical trading strategy they have employed on one instrument can easily be adopted to the gold market, especially given gold tendency to form durable trends. For example, many traders have found success at adapting strategies based on trading lines, Fibonacci analysis, and overbought oversold oscillator like RSI and stochastic. A simple short-term strategy catch the meat of the trend with a moving average crossover. For a short-term trader, a classic way to try to profit from the improvement trend in gold is to use a moving average crossover strategy. In this strategy, a trader should look to buy gold if a short-term moving average crosses above the long-term moving average and sell when the short-term moving average goes below the long-term average. Traders differs in their opinion on the best time frame for the two moving average, but we have found that 10 10 and 60 moving average crossover on our chart can be very strong combination of short-term trade. Historically, these settings have allowed traders to successfully trend the middle portion of a trend, though there is no guarantee of the future performance. The chart showed how this market strategy should be applied in gold on our time frame. Okay, the moving average. You can see the moving average. This was 10-hour moving average 60. Okay, look at the chart. These are use of indicators. At points H1, the short-term 10-hour moving average crossed below the long-term 60 period average, suggesting that traders should enter a sell trade as a bearish trend may be forming. The moving average did not cross again until points H2 a few days later, after gold has trenched down to its upper 1,200. At this point, as to the initial sell trade is closed for a solid gain and a new back trade is triggered at the trend sheet back to the top side. Okay. After a brief consolidation, gold rallied back into the lower 1,300 and the trend is closed on a bearish moving average cross at point 3. Like any methodology, though, the strategy will produce losing trade as well. In this case, the big spike near point H4 causes the sell trade from H3 to be stopped out for a loss. It's also important to note that the trade must be closed at the market price near 1,330 when the cross occur, not the 1350 levels where the two moving average actually crossed. Okay. The simple trading strategy can help trader catch the middle portion of trend in more volatile trading environments like the one I highlighted above, but using it when gold is merely consolidating in a range can lead to a series of consecutive losses. Trades as a result, traders may want to consider supplements this strategy to other indicators to improve its long-term probability. So this is all about gold, the history of gold, how gold moves. And saying there's no strategy that is perfect. So master your own strategy. Know your wins and your losses. Try to cut your losses and try to improve your wins. Hello guys, we have come to the end of the video. Please subscribe, share and comment. Goodbye.